Hi, Justin Bergner, Portfolio Manager here. Yesterday's announced Transcontinental merger between Union Pacific and Norfolk Southern will set into motion a near 2-year regulatory process with a number of cross currents. The deal ended up coming out at a 23% premium to Norfolk Southern's unaffected share price, which led both stocks to trade down modestly. Folks were expecting a 25 to 30% premium and a higher cash component versus the near 30% cash component that ended up being part of the deal. So what happens next? Well, the market's pricing in close to 50% probability of deal success. We think that may be a bit too high. This merger will set into process a consideration of a potential Burlington Northern CSX merger, which would presumably be announced in due time. So you'd have to see 2 transcontinental mergers rather than 1. And we think that the benefits of interchange efficiencies can be achieved through other means than a merger of railroads. Finally, there's some uncertain effects for the railcar supply chain, namely manufacturers and lessors. Rails will now be able to do more with less, which means the need for fewer rail cars. Also creates some uncertainty with respect to secondary market activity. Ultimately should create better conditions for long-term railcar growth, but with some short-term uncertainties. Thanks.